Hi everyone. Today I decided to show you a small financial model of a startup. This model will show you how you can create the structure of the inputs, of the revenues, expenses, investment plan expenses, payroll, fixed costs, direct costs, and so on. I will be showing you how you can create the financial model, what type of inputs may affect the financial efficiency of the startup. So please like, share and subscribe to our channel. We have more than 400 financial models, so we will be overviewing them one by one, so we have a huge experience in this area. So today I just decided to show you a very small startup. So this business owner just decided to create a simple tool that will be showing him different scenarios of operating activity, how much financing they need in this scenario, that scenario. So this financial model should be able to should be very flexible in building stress tests, different scenarios. So we decided to create a very simple tool that I will be overviewing today. So first of all, we create a rule saying that all inputs should be colored with a specific color, specific font, specific background. So our inputs color will be blue. So these are the inputs, these are the inputs, these are the inputs, these are also the inputs. All other cells are formulas, so we're not touching them. So this is a very convenient thing, because when you are done with building your model, you will be playing with scenario building and stress testing. You will give this model to different third parties. They will be playing with your model. They will be creating different scenarios. They will be showing you different versions of your model. So you will be discussing. So this financial model should be convenient for all the third parties, your business partners, your bankers, whoever. So to make it more convenient, just create the rule. You need to highlight somehow all the inputs. So this is rule number 1 that you have to apply to your model. So first of all, we are setting up the first year of financial projections when the investment stage begins. Then we need to specify when we get the first revenues, month and year. This is the point number 2. Then we need to, so if you have any business idea in mind, you need to divide all your customers in different types. So remember that you can't think using just one average customer. So you need to divide all your customers into different types, because they will be consuming your product or your service different ways. So they will be staying with your product or your service for a different time. They will be consuming your product or your service more intensive or less intensive. So this is also, there are a lot of parameters that affect the duration of the life cycle, the intensity of how the different customers consume your product or your service. So bear it in mind, because later when your financial model is ready, you will be switching on and off different types of customers and see how they affect the cash flow, the amount of financing that you need. Maybe you are too optimistic with this or that type of customer, and when you are switching it off, you will see that you need to rethink your business concept, because your cash flow will be showing that significant decrease in revenues, significant increase in payback period. So you will say to, first of all, to yourself that I need to rethink my business concept. It will take you some time to rethink it. So usually, so the next important rule is just try to
try to divide your customers into different types, so you will be able to switch them on and off, see how this affect your business cash flow, payback period, and so on. So this will be very valuable for you during stress testing, during scenario building. So you will be playing with it a lot, I guarantee. So a lot of people are playing with this. It takes them maybe a month or 2 months to play and to build different scenarios, optimistic, pessimistic. Let's say it takes them a lot of time before they make some final decisions. Then you need to specify the duration of the life cycle for different types of customers, because some customers will be staying with you for 3 months, some of them will be staying with you for 6, for a year, 2, 5 years, and so on. So other customers will be just purchasing your product or service just once and then quit. So you have to model different types of customers inside your financial model. So if you, for example, switch off the optimistic, let's say so, customer, you will be able to see that your cash flow looks badly. So you need to divide your customers into different types that take into consideration how much time will they stay with your business, because this will significantly affect the recurring revenues. This is crucial for recurring revenues calculation, because the majority of your customers won't stay with you forever. One day they will quit. So this block of inputs significantly affects the accuracy of revenue generating algorithm, showing you more correctly the cash flow, the financing amount needed, the payback period, and so on. So this is about recurring revenues. The majority of custom entrepreneurs, they calculate recurring revenues in the wrong way. So you need to take into consideration that you have different types of customers. Some of them will stay with you 2 months, some of them will be staying with you for 6 or a year or 2 years or 5 years, and some of them may stay with you they may make just one purchase and then quit. So this is very important. Then, for example, if they make some purchase, the initial purchase, they, for example, download the app, they may pay you some, they may make some revenues, for example, for the initial purchase. So if there is some kind of initial purchase revenue exists, you may specify it here. For example, if you download the app and the download is, you need to pay for download, so you can specify it here. If you have some direct costs that connected to this initial revenue, you can specify it here. And then we're moving to the next block, 2 blocks of inputs. So here we need to specify how different types of customers consume your product or your service. So for example, if the life cycle equals to 3 months, we need to specify for this specific type of customer what revenues monthly are being generated by this type of customer. If the life cycle equals to, let's say, 5 months, you will have to specify the revenues for this type of customer during first 5 months of the his operating activity inside his life cycle. So we're doing it, so the first 12 months we're doing it manually. If the life cycle is more than a year, the 12 months is being extrapolated. So here we're specifying for each type of customer the revenue that he brings to our project. So if we set up, for example, 7 months duration of the life cycle, we'll need to specify the revenues here during the first 7 months of operating activity. Then this customer quits our project.
So here we're specifying the revenues inside the life cycle of the customer. Here, if we do have any direct costs that are linked to these revenues, we are doing the same for the direct costs. So these are the revenues of one customer of each type, and these are direct costs for each type of customer during the life cycle. So these are the revenues, these are direct costs. So if we, let's say, decrease the life cycle to 4 months for the customer type number 10, we will be shown that we need to delete these values and these values. So this is how it works. So this is also very important, so bear it in mind. So you need to specify how each type of customer breathes financially in types of revenues and direct costs inside its life cycle, because this affects the revenues, direct costs, cash flow, amount financing needed, payback period, simple, discounted, net present value, internal rate of return, and so on. So then we are moving to another component of the revenues, the amount of new customers. So here in this block of inputs, so once we specify the moment of the first revenues, May 2020, so we specify here May 2020, then May 2020 appears here, and then we specify how many new customers join our project. So we're saying that these two customers that start using our app or anything else in June 2020. So we start counting 3 months since June 2020. So these two customers will be staying with us for 3 months, and in August 2020 they will quit. So this block of inputs is dealing with description of only new customers that are joining our project. All the recurring revenues are being calculated automatically according to the customer life cycle and the way different customers behave in terms of revenues and direct costs. Then, so we are specifying the amount of new customers inside 4-year period, and then we are extrapolating the last month of 4-year period. We're extrapolating these values of new customers on other months of operating activity inside our project horizon. So the project horizon is 10 years, but for first years of operating activity we're able to specify month by month manually. So this will affect significant. So why we need these? Why we need all these details? So these details, so the way we will be specifying the amount of new customers, this will significantly affect the cash flow, and you will be able to see the operating losses. So the most important part of this block of inputs is that playing with this amount of new customers, you will be able to see the amount of operating losses that you will need to add to the investment plan expenses to be able to see the total financing needed to start the business, because the amount of money you need consists of two components. The first component is investment plan expenses before the revenue begins, and the second component is our operating losses. So here they are. So the amount of money you need, so the total financing needed, this value consists of investment plan expenses plus operating losses, and you will need to calculate different scenarios of operating losses. You will be calculating these losses playing with the amount of new customers, and usually entrepreneurs are switching on and off different types of customers, so they will be able to see the difference between different scenarios, how the cash flow statement will behave, and what amount of operating losses you will have to compensate using your own funds or bank loan and so on. So you will be playing with all that inputs a lot, looking at the cash flow statement, and you will be able to see how much financing you will need if you switch on and off different types of customers, or you will be playing with the amount of new customers that will be joining your project in this very moment inside the timeline, or they will be joining your project later, and you will have bigger operating losses. So usually entrepreneurs are playing with all these inputs a lot, because this affects the amount of money they need. So sometimes they see that the amount of money they need is bigger than they have, so they need to postpone the business start, or they need to rethink their business concept. So this tells them a lot. Sometimes they say that we need to wait a bit to accumulate more funds before they start. So this block of inputs tell them a lot. Then they're specifying the discount rate, looking at discounted payback period. So here are the main financials: simple, discounted payback period, profitability index, net income, net present value, total financing needed, that consists of equity, loan, internal rate of return. Then you may specify several loans. So here they are. Here are the loans. You can specify the amount of loan, when we get this loan, year and month, term of loan, interest rate, grace period for interest payments and principal payments. So you can specify several loans for that. All these loans will be traveling here inside the cash flow. This is the inflow for the loans. These are interest rate payments. These are principal payments. So you can see all the details. Now let's go back to our inputs. So here we have a simple environment for the payroll. We are specifying the list of positions, payroll per person on each position, the amount of people on each position. Then we describe the fixed costs, the names for the fixed costs. Then we specify the dollar per month value for each fixed cost. Then we're moving to the investment plan expenses. Here we can specify what we are investing in, price per unit that we invest in, how much units we are investing in, when we are investing, month and year. If we have some depreciation for this investment plan item, we specify yes or no, and then we specify how much time it will take us to depreciate this investment plan item. So this is the investment plan. And then we're moving to taxes. So here we can specify the tax rates. We may not have value added tax, asset tax, salary tax, net profit tax, and so on. So these are the tax bases for these taxes. These are the rates. And then all these inputs are flying inside the cash flow statement. Here we can see the revenues. We can press plus and we will be able to see the detailed revenues. The same story with payroll, fixed cost, direct cost, taxes, investment plan expenses, loans, interest payments, principal payments, and so on. So then we have charts, very simple charts: simple and discounted payback period, loan coverage ratio monthly, revenues and total costs monthly, profit monthly, profitability monthly in percentages, cash balance at the end of the period monthly inside the timeline, operational profit and debt. Then the same charts done
yearly. Profit, profitability, cash balance at the end of the period, operating profit and debt, a loan coverage ratio. Then the next step illustrates us cash flow statement done yearly, P&L statement done yearly. Very simple table showing us the revenues, total costs, profit, profitability, cash balance at the end of the period, operating profit, and so on. So these are just main numbers for the project for the entrepreneur. And then we also entrepreneurs, once financial model is ready, so they are building different scenarios, and then they need to understand how stable this or that scenario is. So for that purpose, they are using sensitivity analysis. In this particular case, we can do sensitivity analysis for the revenues, payroll, fixed costs, direct costs, investment plan expenses, interest rate, and the loan amount. So we can specify the step of changing the parameter. In this case, these are the revenues. So what will happen to financials if the revenues will be growing or decreasing with this step? So we can change this step here. Like, as we can see, the numbers are changing here. So what we can do next, we can press this button and see how the financials will change, how stable this particular scenario will be if we increase or decrease the revenues with this step. So here it is. So it works very simple. We can increase, let's say, the step to 20%. We can delete the previous numbers, press sense again. So now we know how the project behaves if the revenue or the revenue increases or decreases with this step. We can do the same for the payroll, so the logic is the same. So this is how sensitivity analysis works with the payroll, fixed costs, direct costs, investment plan expenses, interest rate, and loan amount. So usually what business owners do, so they go to the model tab, they create different scenarios. So for example, they would like to switch off several customers. Let's say they would like to switch off these type of customers. Maybe they are too optimistic, so they just decided to rethink their business concept. Then they go to the sensitivity analysis tab. They are deleting the stress testing numbers for the previous scenario. Then they press sensitivity analysis button again and see how the project will behave if we switch off these types of customers, what numbers of net present value, financing needed we will be able to see. So we can, for example, leave them off. So now you can see how sensitivity analysis works. So I hope you enjoyed this financial model overview. So we will be overviewing lots of different financial models for different types of and scales of businesses, chains, and so on. So if you find these overviews valuable, please like, share, and subscribe to our YouTube channel. Here we will be posting lots of Power BI tutorials and financial model overviews. Thank you so much. See you in next videos, and bye.